Welcome back to the Deep Dive. We are transporting ourselves to the cutting edge of the media landscape today. It is February 2026.
It is.
And if you've been paying attention to the headlines, the world of entertainment feels like it is moving at just warp speed.
Mm.
But we're not looking at a scrappy startup today.
No, not at all.
We are looking at a giant Warner Music Group.
It's a fascinating moment to be analyzing this company. I mean, you have this massive legacy, Titan home to Atlantic, Warner Records, all of it. And they're navigating a tech environment that is, well, it's rewriting the rules of engagement every single week.
And usually when we talk about legacy companies meeting disruptive tech, the story is about survival. Trying not to drown.
Right, treading water.
But we've got the Q1 2026 earnings report right here, released just a few days ago, February 5th. And I have to say, the narrative isn't survival. It sounds a lot more like aggression.
That is the perfect word for it. We've gone through the transcript, the press releases, the financial snapshots, the whole stack. And the mission for this deep dive is to unpack exactly how a traditional music company is delivering serious growth right now, while simultaneously disrupting its own business model for tomorrow.
And doing it with a robot in the room, which we will definitely get to. But first, we have to ground this in the numbers. Because no matter how cool the tech is, money tells the truth.
It always does.
Warner Music Group, first quarter 2026. What's the view from 30,000 feet?
The view is surprisingly clear, and the headline is efficiency. If you just look at the top line, total revenue hit $1.84 billion.
Okay.
That's up 7% in constant currency.
Which for a mature major media company, that's a solid number. High single-digit growth is respectable.
It's healthy. But if you stop there, you miss the actual story. The real action, the thing that likely has investors sitting up straight, is the profitability. Their adjusted OIBDA jumped 22% to $463 million.
Okay, let's pause there for a second. We hear OIBDA a lot. Let's decode that for everyone not currently sitting on a trading floor.
Yeah. Sure. It stands for operating income before depreciation and amortization. Basically, strip away the accounting magic, the tax strategies.
Yeah.
This is the core profit generated by the actual business operations.
Got it.
And that number is up 22%.
So revenue is up 7%, but core profit is up 22%. That is a massive gap.
Yeah.
How do you widen the gap that much?
That is the magic of what we call operating leverage. It essentially means that for every new dollar of sales they bring in, they're spending significantly less to earn it.
Oh, okay.
Their margins expanded by about 310 basis points this quarter alone.
310 basis points. In plain English, that's roughly 3.1%, right?
That's right.
In the context of corporate margins, is that a big deal?
It is huge. I mean, expanding margins by over 300 basis points in a single quarter is the kind of efficiency that makes Wall Street drool. It signals that the restructuring plan they launched a while back is actually working. They targeted about $260 million in annualized cost savings by the end of fiscal 2026, and we're seeing that flow directly to the bottom line right now.
So they're running a much tighter ship.
Yep.
But you can't just cut your way to growth forever. You need cash to invest.
And they have it. This was the other number that just jumped out at me. Operating cash flow grew 33% to $440 million.
Wow.
And catch this, their conversion ratio was nearly 100% of their adjusted OIBDA.
Meaning the profit they reported on paper actually ended up as real spendable cash in the bank.
Precisely. Often in media, profit can be a bit of an accounting fiction while cash is tied up in, receivables or licensing delays. Here, the cash is real.
And that's firepower.
That is what they call firepower. They aren't just hoarding this cash, as we'll discuss later with their catalog strategy. They are preparing to deploy it.
Okay, but before we get to the spending spree, I want to touch on where the money's coming from. Streaming's been the engine for, a decade now? Is that engine sputtering yet?
Not yet. Subscription streaming revenue is up 11%. Even ad-supported streaming, which can be volatile, grew 4%.
And that's with a headwind, right?
A pretty significant one, yeah. You have to view those numbers in context because they were operating with a handicap this quarter.
Right. I saw a note about BMG in the papers. What happened there?
So Warner had a long-standing distribution deal with BMG, another major music rights company. That deal ended.
And that cost them.
That termination wiped out about $6 million in revenue just this quarter.
So they lost a guaranteed $6 million check, and they still posted 11% subscription growth.
Exactly. It proves that the organic growth people actually listening to Warner artists like Zach Bryan and Bruno Mars is strong enough to eat that loss and still drive the company forward.
Okay, speaking of the artists, let's talk about the catalog. This was the part of the earnings call that I found absolutely wild.
Oh, yeah.
We talk a lot about viral moments on TikTok or whatever, but Warner seems to be turning that random virality into like a hard science.
This is the Stranger Things effect. It's a perfect case study in modern asset management. It's not just about putting a song on Spotify and hoping people find it.
It's manufacturing relevance.
Exactly.
So for context, Netflix released the latest season of Stranger Things. And obviously the show has a history of blowing up old songs. But this time, Warner had some heavy hitters in the mix.
They did. They had Prince's Purple Rain and David Bowie's Heroes. Now, traditionally, getting a sync that's placing a song in a show is a nice bonus.
Sure.
You get a licensing fee, maybe a little bump in sales for a week or two.
All right, a nice little sugar rush for the revenue.
Exactly. But the new model is about changing the valuation of the asset permanently. CEO Robert Kinkle was very specific about this on the call.
So what did he say?
After the season finale, streams of Purple Rain obviously spiked up 600% week over week.
Sure, but spikes crash. That's the nature of viral trends. Everyone listens for a week and then they move on to the next meme.
Usually, yes.
Yeah.
But Kinkle focused on where the streams settled after the hype died down. Purple Rain didn't go back to its old numbers.
It didn't.
It settled at a new baseline that is 6 times higher than it was before the show aired.
6 times higher. Permanently.
Well, permanently is a strong word, but for the foreseeable future, yes. It has plateaued at that higher level.
Wow.
And David Bowie's Heroes saw a 300% increase during the show and settled at a baseline 2.5 times higher.
So if I'm an investor looking at their library, these songs just became significantly more valuable assets, essentially overnight.
It changes the entire lifetime value of the copyright. Think about what actually happened. You have reintroduced the brand of the artist to a generation that maybe knew the name Prince, but didn't have Purple Rain on their playlist.
Now they do.
Now they do. It shifts the demographic of the listener, which extends the earning power of that song by another 20 or 30 years.
It's like discovering a new oil well in a field you thought was empty.
And they aren't just relying on the legends, right? I mean, they seem to be doing pretty well with new music, too.
They are. It's a mix.
Yeah.
You have Zach Bryan, his album With Heaven on Top debuted at #1. He is an absolute juggernaut right now.
Oh, yeah?
And you have the return of Bruno Mars. I feel like we have been waiting for a solo Bruno album forever.
Yeah. It has been a decade, 10 years. His new album, The Romantic, drops later in February, but the single I Just Might already hit #1. And here's a fun fact that shows the depth of their roster. Warner Chappell Songwriters, that's the publishing side, contributed to half of the top 10 most streamed songs of 2025 in the U.S.
Half the top 10. That's immense market share.
It's significant. It shows they aren't just relying on one or two superstars. The machinery underneath, the songwriting, the publishing is capturing value, even when the artist might be signed to a different label.
Okay, so the legacy business is healthy. The catalog is booming. But now we have to pivot to the elephant in the room, or maybe the robot in the room, artificial intelligence.
This is where the Warner strategy really diverges from what you might expect from a legacy company.
Right. If we rewind a year or two, the narrative was AI is going to kill the music industry. Robots will steal the songs. You know, Suno and Udio are the enemy.
Yeah, a lot of fear.
But reading this transcript, the tone from Robert Kinkle is completely different. He sounds oddly calm, optimistic even.
He is. Kinkle's philosophy is fuel, not fire.
That is a catchy slogan. What does it actually mean in practice?
It means you can view AI as a fire that burns your business down, which leads to the strategy of blocking everything and suing everyone, or you can view it as fuel for growth. Kinkle believes the industry cannot view AI in black and white. He wants to find the equilibrium in the shades of gray.
And this isn't just philosophical musing. They are backing it up with actual deals.
They are. Warner has signed consumption-based deals with the major AI music players: Suno, Stability, KLA, and Udio.
Okay, let's pause and make sure we understand what these companies do. Suno and Udio, these are the tools where you type in a prompt like sad country song about a lost truck in the rain.
And it generates a fully produced song in seconds.
Correct. And usually the music industry's reaction to that technology is, you train that on our music, we're suing you.
And lawsuits are happening, sure, but Warner is saying, we want to license this.
So how does that actually work? If I use Suno to make a song, does Warner get paid?
In these new deals, yes. The key word is consumption-based. Meaning, Warner gets paid based on usage. If their catalog or their artist's data is used to generate content that people engage with, Warner takes a cut. They aren't just selling a flat license, they are participating in the upside.
That seems like a risky bet. Are they assuming people will actually listen to AI music?
They're assuming people will make it. This leads to what Kinkle calls the superfan economy. This is, and I'm not exaggerating, the biggest potential shift in the business model since the launch of Spotify.
Explain that, because right now I pay my $11 or $12 a month, and I get access to everything.
And that is a low ARPU, model average revenue per user. It's capped. You pay $12 whether you listen to one song or 10,000.
Right.
Management believes the future of streaming includes superfan tiers.
So I pay more, but what do I get?
You get to create. You pay a premium, say $20 or $30 a month, to use these AI tools to legally remix, reimagine, or generate music using the catalog.
Wow.
Imagine being able to take a Bruno Mars track and, using an official tool, create a new version of it, or use his voice for a project legally.
That is wild. It shifts the listener from being a consumer to a creator.
Exactly. It moves from passive listening to active creation. And for Warner, that increases the ARPU. If they can get you to pay double your subscription fee for those tools, that doubles the value of a subscriber.
But isn't that incredibly risky? I mean, what about the artists? Do they want people messing with their songs? Do they want fans putting words in their mouths?
That is the big ethical friction point. And Kinkle laid out 3 non-negotiable ethical principles on the call to address this.
Okay.
First, partners must license the content, no stealing. Second, economic terms must reflect the value of music, so that consumption-based payment we talked about.
And the third one, I'm guessing, is the important one.
Opt-in. This is crucial. Artists and songwriters must have the choice to opt in for their voice or likeness to be used. They are not just signing away their digital soul by default.
That feels like a very important safety valve. So if I'm Zach Bryan, I can say, no, I don't want AI versions of me. And Warner respects that.
That is the promise. It creates a safe environment for the artists to experiment without feeling exploited.
It effectively splits the roster into 2 groups. Those who want to be platforms for creation and those who want to remain traditional artists.
Precisely. And the bet is that enough artists will see the revenue potential and say yes.
It also seems like they're using AI for the boring stuff too, right? Not just the cool creative stuff.
Oh, absolutely. They mentioned using AI for marketing, creating motion art and videos cheaply. They're using it in legal and finance to cut costs.
Which connects back to that margin expansion we started.
Exactly. If you can automate the back office, you keep more of the profit.
Fuel, not fire.
Mm-hmm.
It really is a complete strategy. Now, earlier you mentioned they have a lot of cash and firepower. What are they planning to buy?
Well, they have a joint venture with Bain Capital.
A private equity giant.
Yes. They have a fund specifically set up to buy music catalogs, and they just announced they're increasing the capacity of that fund from $1.2 billion
What?
to somewhere between $1.65 and $1.7 billion.
That is a massive war chest. Almost $2 billion to buy songs.
And they plan to deploy a significant portion of that by the end of this fiscal year. They are going shopping.
Why the rush? Why buy catalogs now?
Because they're hunting for high-margin assets. Think about it. When you buy a catalog like David Bowie's, you don't have to pay for marketing anymore. You don't have to pay for tour support.
You just collect the streaming checks.
It boosts their recurring revenue. It's the closest thing to an annuity in the entertainment business. And it improves their profit margins.
And it feeds the flywheel.
What do you mean?
It all connects. They buy the catalog, they use their marketing machine to get a sync and a hit show, the streams go up, and now they might even license it to AI for fans to remix.
It is a flywheel. And it differentiates them from a pure tech company. A tech company has the tools, but Warner has the rights. You can't have a legally licensed Bruno Mars AI without Warner.
Now, we've been pretty positive, but surely there's some risks here. It can't all be smooth sailing. What are the headwinds?
There are definitely drag factors. Physical sales, so vinyl and CDs, actually declined 11% this quarter.
Ouch.
Yeah.
Is the vinyl revival finally over?
Not necessarily. They noted it was a tough comparison against last year. In Q1 2025, they had massive releases from Linkin Park that drove physical sales. They didn't have a comp for that this year, so it might be a blip, but it's something to watch.
And geographically.
Asia is lagging. The earnings report specifically mentioned that the Asia region is underperforming. They're making leadership changes in Japan and the wider region to try and fix it, but right now that is a drag on their global growth.
So if you're looking for the weak spot in the armor, it's physical sales and the Asian market.
Correct. But the digital growth and the efficiency gains are currently overshadowing those issues.
So let's zoom out. We've gone through the financials, the catalog viral moments, the AI strategy, and the acquisition war chest. If you had to summarize the state of Warner Music Group in February 2026, what's the headline?
The headline is that WMG is successfully transitioning from a record label into a music tech hybrid. They are hitting their financial targets. High single-digit revenue, double-digit profit growth, while aggressively positioning themselves for the next era of the internet.
They're not waiting for AI to happen to them.
They are happening to AI.
That is a great way to put it. They're trying to be the architects of the new rules rather than the victims of them.
Exactly. And for you, the listener, the takeaway is clear. The music industry is shifting. We're moving from a model where you just listen to songs to a model where you pay to play with the songs.
Which brings us to a really provocative thought to leave you with today.
Mm.
We talked about this super fan tier where you can use an artist's voice to create new music. If AI tools allow every fan to become a creator using their favorite artist's voice legally, with permission, does the definition of artist change?
Yeah.
Or does the original artist just become a platform?
That is the billion-dollar question. Is Bruno Mars a singer, or is he a suite of creative tools that you subscribe to?
It sounds like science fiction, but based on this earnings report, it is the business plan for 2027.
It certainly seems that way.
Fascinating stuff. We will be watching closely to see if those AI deals actually turn into the revenue they're promising. Thanks for joining us on the Deep Dive.
Always a pleasure.
And thank you for listening. Keep creating, keep listening, and we will see you on the next one.